In today's episode, we are going to talk about how assumable loans can benefit both buyers and sellers in today's marketplace. To help us with that, we have Esteban Reyes with Realty One Group. We are going to talk about what type of loans are assumable. How do you find these assumable loans if you're a buyer in the marketplace? If you're a seller, how do you find out if you have an assumable loan? How can you sell at a premium if you have an assumable loan with a low interest rate? So if you are interested, if you're a buyer, in getting a 2, 3, 4% rate in today's marketplace, you don't want to miss this. If you're a seller and you have an assumable loan and you want to sell at a premium, this is an episode you don't want to miss. Welcome to the show, Esteban. How are you?
Jose, thank you for having me. Everything's great, thank God, brother. How you doing?
Good, man. I just wish I was in Miami, Florida right now,
It's hot today, but yeah, man, it is beautiful. We are very blessed to be here.
Cool.
What part of California are you out of?
It's in Southern California, which normally it's
Okay,
pretty nice weather, but it's a little chilly. So I know Miami would
okay.
be nice and warm right now. So
It is. It definitely is. Today was. It's been pretty warm. That's why
cool.
I'm now rocking the tie.
I love it. So let's talk about assumable loans. How does a buyer find an assumable loan, or how do you know if a loan is assumable?
Very good question, Jose. So, by the way, first of all, I wanted to take this time to appreciate. Thank you for inviting me to your show. Thank you for having me, and thank you for talking about this uh, part of the industry, this particular subject, which I have come to find out that there's not a lot of information out there, and there should be more, especially with the current rates. And the best thing about it, it's something that it's bilateral. Not only buyers benefit, but also sellers benefit. So it's a mutual benefit on both parts. So as the term states, assumable loans are loans that can be assumed by a buyer from the seller, and the easiest way to find out is just to ask, right? Ask the listing agent as a buyer's agent, or as a buyer, ask your agent to find you. There's ways, actually, at least in our MLS here, to filter those listings that have assumptions. And I've come to find out that there's not that many listing agents that really ask. But once we ask, especially for those listings that have been in the market for 60, 90 plus days, they're willing to take that extra step to see if it's something that could be done, which obviously helps, move our inventory.
How do you find out if it is or isn't?
So first of all, there's only three types of loans that are assumable. First of all, VA, FHA, and USDA. Down here in Miami, I've been doing this for just under a decade, and I've still to come across a USDA, but all VAs and most FHAs are. I have heard that some conventionals, some banks will, some servicers will allow on conventional deals, but definitely on VAs and FHAs. So how do you find out? You ask your seller, ask the homeowner to call the bank and see if it's something that they're okay with doing.
Or all
From experience, sometimes you got to make a couple calls. At least when the rate started to increase and this started to to become a norm of asking, we've kind of felt like a lot of representatives from lenders from banks were not in the know-how, or were not aware. But now in the last couple of months, most people definitely, when you ask the question, they know whether or not.
how are all FHA and VA loans assumable?
All VAs are, not all FHAs, from what we've been told.
Got it. Okay, cool.
Hmm.
And then, what is an assumable loan for somebody like wondering what that even is?
Great question. So, an assumable loan is where a buyer takes over the loan from the seller. So basically, takes over the payments. Now, just to clarify, this is not a sub-to deal. All right. Sorry, Pace. This is not a sub-to deal. This is actually where the bank knows and processes the transferring of the loan from the seller to the buyer. Um, what's the benefit of this? Well, if we have a seller who has a 2 or 3, even a low 4% rate, as we know, as of today when we're recording this video, rates are right around 7. So being able to tap into 2 or 3%, saves our buyers a lot of money. And on the selling side, um, it helps move inventory. As a seller, um, if you're able to advertise your property, or as a listing agent, if you're able to advertise your listing that, hey, you're a buyer can take over this loan as long as they qualify, it's a huge selling point.
Do
I'll share something even with you right now. Most of my listings, I'm sorry, not most, all of my listings that have assumable loans, that's the first sentence. Want to have a 2.75, want to have a 3.25, whatever the rate is, then this home is for you. Ask us how, and then obviously then we go into describing the property.
Got it. So,
Mhm.
do properties that have assumable loans generally sell at a premium?
That's a good question. It really depends. From my experience, it has come down to the equity, because that's the catch with assumable loans, right? So just like the rate doesn't change, the loan amount doesn't change. So I'll give you a prime example. Uh, we have a listing that currently has a $350,000 loan amount at a 2.75. This is a VA loan, just under 260. Let's just round it down to 250. And I'm sorry, 350. And we're selling it for 500, right? So that 350 could be assumed by the buyer. Now that gap is where we have to find, you know, some creativity, right? And normally, from my experience, there's 3 different ways that we can get that done, right? So number one, the easiest route is where the buyer covers that difference. So again, in this example, if it's 5, we're selling it at 5, and it's the loan amount is 350, then the buyer would come up with that 150 difference. The second option is where the buyer is able to get a second loan, second mortgage, or a HELOC to be able to cover that difference. Now, thankfully, we partner with a local lender that, at least here in Florida, is able to do this, and they're able to cover up to a combined loan to value of 90%. So in this particular scenario of that $500,000 property, we have 350 already with the assumable loan. This lender could give us 100,000 to get to that 90%, and then the buyer would be able to cover that 50 out of pocket, or would have to cover that 50 out of pocket. And then the third option um, that of that we can also do is where either the complete amount or a portion of that difference could be done through seller financing. So it's just a way to get creative to be able to, again, have buyers benefit from these low rates and help our sellers move inventory.
What's the name of the bank that does the HELOCs for you guys at the 90% down in
So
Florida?
they're part of through our brokerage. They're called our One Alliance, One Lending Alliance. We have 3 particular branch managers that have already tapped into that. Now they're only currently doing it in Florida, uh, but I'm sure, again, as this continues to expand, um, more states are going to be open to it.
Oh yeah, not only that, but it's great that they're able to do that as well too. What is the
Mhm.
process like? Let's say that you have a buyer that you find a seller that has an assumable loan, they accept your offer. How long does that assumable process take? Is there an appraisal? Do you have to qualify for the loan?
First of all, time. Um, that used to be one of our biggest issues, was time. Assumable loans would be taking on average, with my first ones, anywhere between 4 to 6 months, right? Primarily because of the fact that, when we were making these calls, lenders were, or servicers, let's say, that were not having uh, the assumable departments weren't as big as they currently are now. We come to find out, obviously, that's something that's not really at top of their priority, right? To them,
Mhm.
primarily the best thing to do is, hey, just pay off the loan and get a new one. But now we've been able to, with our title company that has a ton of experience with these assumptions and knows how to follow up and knows how to submit the packages, we've gotten them down to as little as 45 days. So we haven't equaled that, 25, 30 days closing that we could do on regular deals, at least here in our market, but very close to it. So 45, I would say, would be the soonest that we've been able to do them. Your second question, appraisal. One of the best things about these type of loans, there's no appraisal. Again, unless the buyer wants to, but it's not required because the buyer is assuming that loan. Bank doesn't care really what happens in between loan amount and sales price. And then your final question about qualifying, yes. So the buyer has to be able to qualify for the loan. Now, there is something that we learned recently, and it's that investors could qualify. So investors could qualify. It doesn't have to be primary residence only, but they have to be able to do a full doc review loan. So in other words, they have to have, the income, the credit, etc.
How would that look like if an investor bought the assumable loan? Would they have to put like, or they'd have to cover the gap regardless? But how would that look in terms of qualification?
Just that they were qualifying for an FHA, except the fact that it doesn't have to be primary residence. So as long as they can provide credit score and income, like the loan to value, then it could be done.
Got it. Okay. And then, how do you know if you qualify for like a FHA or like an FHA loan? Like is it the same requirement as when you're getting an FHA loan, or are those requirements different? Like debt to income ratios, credit scores, that sort of thing.
The exact same thing. The exact same thing. And actually, on VA loans, okay, this is the only way for a non veteran to acquire a VA loan. Now, there is a catch with that as well. And it's that if a veteran, if a seller, that obviously it's a veteran that has, a VA loan on their property, lets a non-veteran assume the loan, or even a veteran without full entitlement, then that entitlement gets tied up there until that new homeowner either refis or sells or pays off that loan. So we've come to find out that most of our sellers, by the way, I'm a veteran myself. We help, a good part of our business down here is helping fellow veterans, relocate inbound and outbound of South Florida. A lot of people don't know this, but South Florida is a huge military town. We got Southern Command, Homestead Air Force Base, and a ton of different Coast Guard bases. So for those sellers, those veteran sellers that are not really looking to reinvest or buy something in the future, then yes, they're willing to, to let a non-veteran assume it. But especially for that younger demographic that they're obviously thinking about buying in the near future or sometime in the future, then it has to be veteran to veteran with entitlement, right? That buyer veteran has to have enough entitlement, because if not, again, that entitlement, let's say that 300,000 or 350 in this example that I was giving you, that's actually a VA loan. If a veteran without full entitlement gets that, then that money is going to be tied up for that seller in the future.
Got it. Which means that he can still qualify for another loan. He just can't qualify with his entitlement for 0% down, basically.
Yes and no. So as of right now, the conforming loan limit is just over 800 down here. So let's say in this particular scenario of 350, that the seller, let's say he's willing to give to a non-veteran or a veteran without entitlement, then that 350 is tied up. If he were to buy anything above 450, then at that point, that veteran would have to put 25% of that exceeded amount. So let's say he lets go of 350, he still has 450 left, but he went to, maybe down in your market, what can you get there for 550? The
Nothing.
studio? But let's say he were to go somewhere else and get something for 550. So he's going over that limit by 100,000. All he would have to put, or she would have to put, is 25,000. So that's how it would work.
Got it. Cool. What are the benefits of a buyer doing an assumable loan versus just a traditional loan? And what are the downfalls, or what are the downside of for a buyer of only targeting assumable loans?
So benefits unassumable loans, a couple of them. Number one, again, the main one is being able to get a low rate, much lower than what we're currently seeing, without having to go into the new construction market. And even still, right down here, we're looking at developers buying rates down in the high 3%. So being able to get into a two or even low three is still more beneficial. And then the second benefit, the huge benefit, is being able to lower your closing costs. Again, because it's not a brand new loan, the fees are much lower. On average, they're anywhere between half a point to a full point. No appraisal, right? No origination fees because there's nothing to originate. It's just basically that transfer. So that transfer fee, depending on the lender, it's anywhere between half a point to a point on both FHA and VA.
Got it. Negatives.
Negatives, we briefly talked about it. It's the covering that gap. That's the number one issue when we come across, um, buyers being able to take over loans, is that they don't have enough equity. They don't have enough cash to be able to cover that difference. And even with that combined loan to value, that new strategy that that new tool that we have with that, basically the HELOC, they still have to cover that 10%. So it's still a bit higher, especially for a VA buyers, than 0% down.
I also think that a negative is that it restricts the amount of inventory that is available for you. So meaning like instead of, let's say there's 100 homes on the market, maybe two or three of them or four of them, maybe 10 of them would be assumable, which means that you have fewer choices if you're shopping at properties.
Correct.
The benefit is that you get a very low rate. The negative is that you may not get exactly the house that you wanted, or if you want a certain type of house, you may have to wait a little bit longer to find that specific type of house, basically.
And then also down here, Jose, it's that equity. It's all right. So you're shrinking down, right? Let's say you're from 30 homes in your market. Just throw a number out there, and then you just want assumptions. All right, let's say that from those 10, maybe 10 setters are willing to do it or are capable of doing it. But then we have to look into what are their equity. What's their equity?
Yeah, what's the gap, basically?
What's the gap? Because if you have, let's say, $100,000 to play with, all right, great. But if you only have 20 or 30, then obviously our options tremendously decrease.
Do the lenders allow for that gap to be covered by a HELOC, or how is that process looked upon? Like if it's an FHA loan, are they allowing like the HELOC to come into place at closing, or how is that being done?
They do, because they stay as primary. As long as nobody takes, that first position, they don't care.
Got it. So they can basically have a second loan, even if, as long as they stay on.
Whether it's a HELOC or whether it's through seller financing, which obviously that note will be recorded and they'll know about it. But
Yeah.
Regardless, they to this date, I haven't had a lender have any issues with it.
Yeah. So what I heard about the process, and correct me if I'm wrong, that the process takes different amount of times depending on who the servicer is. Meaning that like some servicers are faster than other servicer.
Correct. Okay. That's accurate too. But at the same time, having the right team by you, in this case, my TC is great with that, as well as our partner title company. They're able to follow through, and the main thing is going over that package beforehand to be able to submit it properly, and that's where.
What does that package look like, just out of curiosity?
It's basically a pre-qualification package, but to this day they're all physical. Like there's no online application. Like you got to print it out, and write down all your assets. Yeah, it's old school. No, Melanie.
Mm-hmm. Really?
Yeah.
Damn. Mm-hmm. Okay. And then in that package, I'm imagining that it's the same type of documents that you would need to qualify for a normal loan, basically.
Correct.
Anything on top of that you would need, or any tips on how to submit the right package?
Honestly, just not to skim through it. Look through it thoroughly, if you have any questions, call the servicer. It could be a little bit of a pain to get through somebody in the assumption departments. But in the recent months, they've been, at least with most providers that we work with, most servicers that we work with, they've been able to help.
Do different lenders have different packages, almost like a short sale package? Different lenders would have different short sale packages that they would submit to the lender. Is it kind of the same thing with loan assumptions?
To be honest with you, Jose, I personally don't get involved in the paperwork.
Love it.
Uh, but from my understanding, yeah, it is a little bit different pertaining depending on the servicer. And it could be, for example, let's just call it lender A and lender B, and they're both VA loans. Their packages could vary, but they're not identical.
Yeah.
That's what I'm trying to say.
So in Ventura County, we've done some assumable loans, and we've done the FHA, we've done the VA, we've done the VA keeping their entitlement, we've done the VA letting their entitlement with the property. In that case, the seller walked away with double the amount of equity that he was scheduled to walk away with because somebody was willing to pay him that much of a premium in order to
Wow.
take over their non VA loan. He was purchasing a property in a different state in cash, so it didn't really matter to him. So he was like, "Yeah, I'll leave it." Um, but what I have seen as well too is that in some cases, depending on the equity or the gap amount,
Hmm.
some of the properties have sold at a premium as well too. Like we had the situation where the lady, her father passed away. She met with two realtors. The realtor said your property could only sell for 550. That would put her underwater. We sold it for like 580, which meant she wasn't underwater because it was an assumable VA loan at 2.8. And since the person was deceased, it didn't matter if it was a VA or a non VA. So somebody got like a really good, basically, loan on the property. So I'm a big time believer in these. And I think that they're almost like a, not a hidden secret, but a lot of people don't know about them. Any final words about like VA assumable or assumable loans and how they can help buyers and sellers?
I would say primarily for those sellers, right? Make sure that you're talking to an agent that understands this or that is willing to learn about it because um, it's definitely a huge marketing tool, at least from our team to help move inventory, and even more especially in those areas where we're seeing so much competition from local developers.
Yeah.
Uh, give you an example. I actually not to the almost what was that from 500 to 580, what like a 8%, right?
Hmm.
More eight almost no, actually no, actually 14-15% increase. I've had deals where, buyers are willing to pay on a $500,000-600,000 property, 15. The max that I've gotten was actually 25,000 over for the seller to be willing to wait that time. This was a couple of years ago, and we kind of knew, hey, it's going to take a little bit longer. So this one buyer said, hey, I'll pay you at 25 over asking, um, just for you to let me assume the loan. All right. But yeah, for those areas where we're seeing a lot of competition from developers, it helps us tremendously.
Very
It helps
cool.
sellers tremendously, yeah,
Good.
and just help and just market it that way.
Yeah, no, and I agree with the statement. Like, whenever we have assumable listings, we also put the very first line assumable 2.8% because we want to grab
Okay.
people's attention as well. If somebody was shopping in Florida or somebody wanted to get a hold of you, how could they do that? And then also, what services do you offer to people looking to buy and sell? Do you offer like a processing service nationwide or anything like that where you help people process these loan assumptions or what yeah, what can you do to help people?
So to contact me, you can reach me via phone 954-709-3034. Call or text me. Also my email info@reyesrealteam.com, or through my social media Esteban Reyes Realtor, um, on both Instagram and TikTok. And through our process, one of the things we've done, especially in the VA market, in the military area, we've built connections with other agents across the country, especially those nearby military installations, military bases, where they're familiar with the assumption process, and we're able to put them in contact with them. And it's been a great way to help our military families that are relocating, again, both inbound or outbound. And in terms of on a local scale, yeah, it's just knowing how to ask these questions, knowing how to explain these to listing agents, letting them know, hey, this is not, and I have nothing against it. None of my team members have it, and nothing against sub two deals. But we come to find out some agents, they've been approached by, investors, letting them, asking them about sub two, and they're not open to it. Also come to find out, it's not that their sellers not are open to it, it's just they don't understand it, therefore they're not explaining it to them. But when we explain, hey, this is, bank is involved, everybody knows, your seller is not going to be liable for anything after closing, everything's going to be transferred, then they're willing to explain it to them, to pay attention. Yeah, correct.
Awesome. Cool, brother. Well, I
Hmm.
want to say thank you for taking the time to be on the show. For our viewers today, we had Esteban Reyes with Realty One Group. We talked about assumable loans for both buyers and sellers. We talked about the gap. We talked about how to qualify, some of the benefits, some of the negatives as well too. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody, make sure to hit that share button. Thank you so much, Esteban. Appreciate you, man. And until next time.